Most people think capital has no conscience. I think that is one of the laziest lies modern finance tells itself. Capital may not have a conscience in the human sense, but it does have a threshold. And every so often, a threshold gets crossed so publicly, so unmistakably, that even the people who worship returns have to admit something larger is moving underneath the trade. That is what I see in this story. Not just a pension fund selling a stock, not just another ethics controversy, not just Europe being Europe and America being America. What I see is a fracture line, a real one, a line running through pensions, technology, policing, immigration, military contracts, public values, and the future direction of transatlantic capital. And when a line like that starts showing up inside retirement money, I pay attention, because pension money is not hot money. Pension money is supposed to be the slowest, calmest, most conservative money in the room. It is the kind of money that does not move just because a headline got loud for a day. It moves when institutions decide something deeper has changed. That is why I want to start with the hard fact. ABP, the Netherlands' largest pension fund, managing 538 billion euros for Dutch civil servants, sold its entire 825 million euro stake in Palantir, not trimmed, not hedged, not under review, sold, gone. And the stated reason was not valuation. It was responsibility, sustainability, human consequences. The fund said, in substance, that those things belong in the investment decision itself. Feifalicite Feiturn 27 File 0 Fe, that is the event. Now let me tell you why it matters so much more than the headline. Because on the other side of the Atlantic, public pension funds in major American states still hold billions in Palantir and are refusing to divest, often pointing to fiduciary duty. That means the split is no longer theoretical. It is institutional. One side is saying ethics belong inside fiduciary judgment. The other side is saying ethics are political noise unless returns force action first. Feifalicite Feiturn 27 File 0 Fe, that is not a portfolio difference. That is a civilizational difference. And once capital starts expressing civilizational differences, you are no longer looking at a stock story, you are looking at a realignment story. I want to say this clearly because people hide behind abstractions when they get uncomfortable. Palantir is not controversial because it sells harmless spreadsheets. The source document describes software built to combine vast pools of data, communications, biometrics, financial records, travel records, and surveillance inputs to track and identify people at scale. It says European critics, including Amnesty International, have warned about human rights implications, especially regarding use by ICE in deportation operations and used by the Israeli military. That is the moral charge at the center of the divestment story. Feifalicite Feiturn 27 File 0 Fe. Now you may agree with those uses. You may oppose them. You may think the criticism is selective. You may think it is overdue. That is not even the first layer of what interests me. What interests me is what pension trustees do once that moral dispute becomes impossible to ignore. Do they say, returns first, always? Do they say, we cannot get political? Do they say our only job is to maximize beneficiary wealth? Or do they say, no, our beneficiaries are human beings living inside a society? And some investments eventually become incompatible with the values those beneficiaries believe their own institutions are supposed to represent. That is the real test, because values are cheap when they cost nothing. The price of values is what you are willing to give up when they cost something real. And ABP paid a real price. That is why this story matters. Now let me give you the master metaphor for the whole thing. I call it the mirror trade. Most people think investing is about buying the future. Sometimes it is. But sometimes investing is about revealing yourself. Sometimes the asset is a mirror, not because the asset itself changed overnight, but because the world around it changed enough that continuing to own it starts telling the public something about who you are, what you tolerate, and what you are willing to underwrite. That is what Palantir became here, a mirror trade. Europe looked into it and saw something it increasingly did not want to finance. America looked into it and saw something it was still willing to hold, defend, or at minimum bracket off as none of ethics business. So long as returns stayed compelling, that is the split. And I am less interested in who is morally superior in some abstract debate than I am in what this tells us about the future path of institutional capital. Because capital follows comfort until comfort breaks. Then it starts following legitimacy. That is what may be happening. Now, the first mechanism in this story is what I call values pricing. A lot of investors pretend values do not belong in markets because markets are supposed to be objective. I have never believed that markets are full of values. They just hide them under different labels: safety, rule of law, governance, trust, contract enforcement, national alignment, reputational tolerance, political risk, consumer legitimacy. All of those are values expressed as price. So when a European pension fund says human rights concerns belong inside investment judgment, that is not some weird moral ad on to finance. It is simply a different pricing model for legitimacy. ABP's public language makes this plain. The fund said it weighs risk costs and also how sustainable and responsible an investment is. That means the ethics are not outside the model. They are part of the model. Fiduciary Turn 27 File 0 Fe. This is a very different posture from the American pension response. The source describes where funds often default to fiduciary duty and treat divestment as a last resort or as a kind of ideological contamination of investing. File site Turn 27 File 0 Fe. Now here is where I want to push harder. Fiduciary duty is one of the most abused phrases in modern finance. It gets used like a shield. People say it as though it means one thing and one thing only: maximize return, by any means not yet illegal. That is not how serious institutions have always behaved. The source itself points out that some U.S. funds previously divested from private prisons or gun makers under moral and reputational pressure. So the truth is not that fiduciary duty forbids all ethical judgment. The truth is that institutions decide which ethical issues they are willing to recognize as financially relevant and which ones they would prefer to call politics. Fiduciary Turn 27 File 0 Fe, that is a values choice too. Which brings me to the second mechanism, selective fiduciary duty. This is one of my least favorite habits in institutional investing. People act as though there is a clean wall between ethics and returns, then quietly tear that wall down whenever the politics are convenient enough. That is why I do not take. We are just following fiduciary duty at face value. I ask which moral discomforts became recognized as investment risks and which ones were told to wait outside. Why are some controversies treated as disqualifying and others as regrettable but investable? Why do some boards respond to beneficiary pressure quickly and others respond with process language and permanent delay? Because fiduciary duty is not a machine that spits out one objective answer. It is a human institution staffed by people deciding what counts as risk, what counts as responsibility, and what counts as tolerable moral distance. That is the real argument here. ABP is not saying return does not matter. It is saying return is not sovereign. That is a profound distinction. And once one major institution says that publicly and backs it with 825 million euros of selling, everyone else holding the same stock has to answer a question they would rather postpone. Why are we still here? Now let me talk about Palantir itself, because it matters what kind of company sits at the center of the split. This is not a snack brand with an embarrassing ad campaign. This is not a retailer that sourced from the wrong factory once. This is a company whose core utility lies in surveillance, integration, targeting, and decision support across security, policing, intelligence, and military contexts. The source describes exactly why European critics view the company as a human rights problem. ICE uses the software in deportation operations. The Israeli military uses the software in operations against Palestinians. And the software's whole commercial proposition is built on finding patterns in sensitive, human-level data. Fiduciary Turn 27 File 0 Fe, that means Palantir is not merely adjacent to coercive state power. It is an instrument of it. Now again, you can say that is good. You can say states need such tools. You can say border enforcement is legitimate. You can say military use is inevitable. Fine. But you cannot say the ethics are incidental. They are the product context. And once the ethics are the product context, long-term holders cannot keep pretending. This is just another software multiple debate. That brings me to the third mechanism, product identity lock. Some companies can outgrow controversy because the controversial thing is a side business. Others cannot because the controversy is not an accident. It is the core use case. That is product identity lock. Once the market broadly identifies the company with a certain pattern of state behavior, the stock stops being valued only on growth, margins, and contracts. It starts carrying a civil meaning. You can still own it, you can still profit from it, but you cannot plausibly claim not to understand what you are underwriting. That is what changes the institutional equation, because now divesting is no longer merely a negative judgment on one quarter or one headline. It becomes a declaration that the whole product identity has crossed an internal line. The source suggests this did not happen overnight. That makes sense. Big institutions almost never move overnight. They move after pressure accumulates, after beneficiary discomfort organizes, after journalists expose, after public contradiction becomes too obvious to smooth over. In ABP's case, the stake became widely known in January 2026. Pension participants objected, and by April the stake was gone, roughly 3 months from revelation to exit. That is not impulsive, that is institutionally fast. Fiduciary Fay turn 27, file 0 Fay. Now pay attention to what that speed tells you. This was not a slow valuation rethink. This was an ethical decision under pressure. And the source says ABP has a pattern here. It exited Caterpillar over bulldozer use in Palestinian home demolitions. It pulled out of Booking and Airbnb on related grounds. That means Palantir is not a random exception. It fits an institutional logic ABP has already demonstrated. Fiduciary Fay turn 27 file 0 Fay that matters enormously. 1. Off divestments can be dismissed. Patterns are harder to dismiss. The fourth mechanism is institutional consistency. I trust patterns more than explanations. Anyone can issue a statement. Few institutions behave consistently enough for the statement to mean anything. ABP appears to be trying to build consistency between public values and capital allocation. That does not make it morally perfect. It does make it institutionally legible, and institutional legibility is very valuable in the coming world. Why? Because the global investing system is entering a phase where values, alliances, human rights rhetoric, digital sovereignty, and geopolitical distance are beginning to affect capital placement much more openly than before. The source spends time linking this Palantir divestment to broader European moves, reassessment of U.S. entities, reduced U.S. Treasury exposure, and wider skepticism about American institutional alignment with European values. Some of those connections are presented argumentatively rather than proven in a narrow causal sense. But the pattern the source is trying to map is straightforward. Europe is not merely regulating America. It is psychologically and financially stepping back from America. Fiduciary Fay turn 27 file 0 Fay that is the larger story. Palantir is one battleground inside a bigger separation. Now let me give you the fifth mechanism. Ethical de-risking. Most investors hear ethical investing and imagine lower returns, self-denial, or fashionable branding. That is because they still think ethics are a luxury overlay. But in a fractured geopolitical environment, ethics can become a form of de-risking. Not because every ethical decision makes money, because institutions increasingly do not want to be trapped funding systems, products, or governments whose future legitimacy may be challenged by their own constituents. This matters a lot for pension funds. Remember what pension money is. It is not adventurous capital. It is deferred life. It is teachers' future grocery money, civil servants, future heating bills, healthcare workers, future rent. If the beneficiaries themselves begin saying, "Why are our retirement savings financing this company and these activities?" then the ethical issue stops being external. It becomes a governance issue inside the fund. That is what happened here. Dutch teachers, healthcare workers, and government employees pushed back after Follow the Money exposed the holding. The money became politically personal. Fiduciary Fay turn 27 file 0 Fay. That is a much more serious force than a newspaper editorial, because a pension fund can ignore commentators longer than it can ignore its own participants. And once the participants begin associating their retirement savings with state surveillance, deportation infrastructure, or military operations they find morally intolerable, the fund has to decide whether return alone is still worth the governance friction. ABP's answer was no. Now, let me talk about the American side, because this is where the story gets uncomfortable. The source says U.S. state pension funds from California to New York continue to hold Palantir and refuse to divest, often citing fiduciary duty or engagement rather than exit. Some participants have protested. The funds are still in Fiduciary Fay turn 27 file 0 Fay. I do not think this is simply because Americans are greedier. That would be too cheap an explanation. I think the real issue is that American institutions are embedded in a different political ecology. Divestment itself has become politically coded. In many states, ESG is treated as suspect. Divesting from certain industries is framed as ideological interference. So, even when moral discomfort exists, institutions may calculate that the domestic political cost of divesting is greater than the reputational cost of holding. That is a different kind of pressure, which leads to the sixth mechanism, politicized inertia. Sometimes institutions do not hold because they are convinced. They hold because moving has become more dangerous than staying. That is politicized inertia. The board says fiduciary duty, the lawyers say last resort, the politicians say stay out of activism, the beneficiaries are divided, the company is profitable, so the institution does nothing and calls that neutrality. But inertia is not neutral when the controversy is real. It is just a decision made in slow motion. This is why I say the transatlantic divide matters so much. Europe and America are not merely evaluating Palantir differently. They are operating under different definitions of what an institution is allowed to say with its capital. Europe appears increasingly willing to say, no, there are some lines where we will sacrifice exposure. America appears increasingly willing to say, no, politics has entered the room, so we will call continued ownership apolitical and remain where we are. Those are different futures, not just different talking points, different futures. Now let us talk about reputational compounding, because this is where people get too narrow. ABP's sale alone will not crush Palantir. The source acknowledges that 825 million euros is only a fraction of Palantir's market capitalization. Fine, this is not a price, impact story in the immediate sense. It is a template story when Europe's largest pension fund exits publicly on ethical grounds. It gives other institutions a precedent, a script, and political cover. Fay Filicite Fay Turn 27, File 0 Fay, that is worth more than one block trade. The seventh mechanism is template risk. Investors often ignore the first institution because the first institution looks isolated. That is a mistake. The first credible institutional defection creates a template. The second makes it thinkable. The third makes it normal. After that, the stock is no longer just dealing with operational controversy. It is dealing with a category shift inside institutional capital. This is especially relevant in Europe, where public pension funds, sovereign wealth systems, university schemes, unions, and regulators all watch each other. The source mentions the UK university pension system facing union pressure over its Palantir stake and references a broader Nordic and European norm of linking divestment publicly to human rights concerns. Again, you can debate timing and intensity, but the direction is plain. Europe is building a more explicit language for values. Based institutional exit, Fay Filicite, Fay Turn 27, File 0 Fay once. That language exists. Every continued holder has to explain itself more often, and explanations are not free. They consume governance time, they raise scrutiny, they create pressure on contracts, they invite regulator interest, they complicate partnerships. That is reputational compounding. Not everything that hurts a company shows up first in the quarter. Sometimes it shows up in the quality of future counterparties and the narrowing comfort of large institutions. That leads directly to the eighth mechanism, contract legitimacy risk. Palantir's whole business depends on state and quasi-state acceptance. If major European institutions are willing to say publicly that the company's uses are inconsistent with their human rights frameworks, that does not just affect passive equity flows, it can affect how European police agencies, ministries, municipalities, and procurement bodies feel about being seen with the product. The source specifically notes the Dutch police use of Palantir software and argues that ABP's divestment creates political pressure for contract review. That is a plausible dynamic. Once the retirement fund for civil servants says the company is ethically unfit for investment, it becomes awkward for another public institution in the same national ecosystem to keep using the company without renewed scrutiny. Fay Filicite Fay Turn 27 File 0 Fay. That is what I mean by contract legitimacy risk. Not that all contracts vanish, that future contracts become harder, more contested, and more politically exposed. Now let me tell you what I think the most important hidden line in the whole story is. The source says European institutions increasingly view ethical investing as core fiduciary responsibility, while American institutions increasingly view it as political interference. That may be the single most important sentence here, Fay Filicite, Fay Turn 27 File 0 Fay, because if that divergence hardens, then the future of capital allocation will not simply be Europe funding different stocks than America. It will be Europe and America operating with different definitions of what pension stewardship means. That is enormous. Why? because stewardship standards become self-reinforcing. Once a pension culture decides that certain human rights concerns are financial concerns, analysts, trustees, lawyers, consultants, and beneficiaries begin treating them that way. Models change, screens change, explanations change, hiring changes, public expectations change. That is institutional path dependence. And path dependence is very hard to reverse. So this story is not just whether Palantir is in or out of one fund. It is whether Europe is coding one set of moral conditions into public capital while America codes another. That is the ninth mechanism, civilizational portfolio construction. People think civilizations clash only in war, diplomacy, and elections. They also clash in index committees, pension boards, procurement standards, and capital screens. That is the quiet layer. And it is often more durable because once you embed a value inside a capital system, you create years of consequences from one governance decision. A pension fund vote today can shape future flows, public discourse, beneficiary expectations, and regulator courage for a decade. That is why I take this so seriously. This is civilization happening in spreadsheets. Now, I do not want to pretend Europe is pure and America is fallen. That would be childish. Europe will compromise when it suits Europe. America will moralize when it suits America. All large systems do. But relative direction still matters. And the relative direction here is unmistakable in the source. Europe is becoming more willing to withdraw capital publicly when product use collides with public values. America is becoming more willing to defend continued ownership publicly by saying values questions should not interfere unless absolutely unavoidable. Those are different futures. Now let me bring this down to the investor level because some people watching this kind of story always ask the wrong question first. They ask, so should I buy or sell the stock? That is not the first question. The first question is, what kind of capital am I and what kind of world is forming around this company? If you are short-term capital chasing contracts, momentum, government growth, and market narrative, you may not care. If you are long-term institutional capital answerable to beneficiaries with stated ethical frameworks, you should care a great deal. If you are a pension trustee, you should care even more, because pension money is not personal speculation. It is delegated moral responsibility, whether you like that phrase or not. And if you are an ordinary investor, you should at least understand this when institutions begin dividing over legitimacy instead of just valuation. The long-term multiple on a company can become a function not only of earnings, but of who is still willing to own it without apology. That is a very different kind of risk. Now let me give you the operating system I would use to think about this story. First, identify whether the controversy is incidental or core. With Palantir, the controversy is core because the disputed uses sit inside the product's central identity. Second, identify whether the seller is acting inconsistently or according to an established pattern. ABP appears to be acting according to pattern, which makes the sale much more significant. Third, identify whether the sale changes price immediately or changes future templates. Here, the template may matter more than the immediate market impact. Fourth, identify whether continued ownership now demands a public values explanation. If yes, the stock has crossed from ordinary controversy into institutional identity territory. Fifth, identify whether your own capital is supposed to optimize return at all moral cost, or whether your institution claims some broader social mandate. Many institutions pretend this question does not exist until a case like this forces it into the minutes. That is how I would think. Not because it sounds elevated, because it keeps me honest about what is actually happening. Let me end where I began. Capital does not have a conscience in the human sense, but institutions do, or they say they do. And eventually, every institution reaches a moment where the market stops asking what it believes and starts asking what it is willing to fund. That is the moment ABP just faced. And it answered with a sale. America's pension institutions, at least the ones described in the source, are answering with continued ownership and procedural language. Both sides are telling you who they are. That is why the €825 million exit matters, not because it was big enough to break Palantir, because it was big enough to reveal Europe. And once capital starts revealing civilizations, the trade is never just about the stock again. It is about which world each side is willing to retire into.